Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. U.S. payrolls beat consensus, but 2025 revisions reshape labor picture. 2. Brent approaches $70 as U.S.-Iran escalation reprices crude risk premium. 3. Takaichi landslide lifts Nikkei to record on fiscal expansion mandate. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. U.S. payrolls beat consensus, but 2025 revisions reshape labor picture. Primary asset classes impacted: U.S. Treasuries, 2Y, 10Y front end, DXY, S&P 500, Russell 2000, Fed funds futures. What happened? January non-farm payrolls rose 130,000, nearly double the 70,000 consensus, while unemployment fell to 4.3% from 4.4%. Prior months were revised sharply lower, with 2025 annual gains cut from 584,000 to 181,000. Average hourly earnings rose 0.5% month-on-month. Why it matters? The headline beat reinforces labor market resilience and reduces urgency for near-term Fed easing. However, massive downward revisions to 2025 payrolls complicate the signal, suggesting the economy was weaker than previously reported. The net read is modestly hawkish for rates, supporting the Fed's patient stance. Markets repriced rate cut expectations further out, lifting front-end yields and briefly firming the dollar before the move faded. Key numbers to remember. January payrolls, plus 130,000 versus plus 70,000 consensus. Unemployment rate fell to 4.3% versus 4.4% expected. 2025 total payroll gains revised from plus 584,000 to plus 181,000. Monthly average slashed from 48,000 to 15,000. Average hourly earnings, plus 0.5% month-over-month, above the plus 0.3% estimate. What to watch next? Friday's January CPI release is now the decisive print. A hot reading combined with strong payrolls would push rate cut pricing toward mid-year or later, supporting yields and the dollar. A benign CPI could revive easing expectations by refocusing attention on the weak revisions. Fed Governor Waller speaks Thursday, offering early post-NFP guidance on the policy reaction function. 2. Brent approaches $70 as U.S.-Iran escalation reprices crude risk premium. Primary asset classes impacted: Brent, WTI, energy equities, inflation break-evens, DXY, gold. What happened? Brent rose 2% to $70.18, and WTI gained 1.5% to $64.93 after the Wall Street Journal reported the U.S. is considering seizing Iranian oil tankers if nuclear talks fail. Reports of a potential second U.S. carrier deployment to the region amplified the risk premium. Why it matters? Iran pumps 3.3 million barrels per day and ships roughly 1.6 million in exports. Any disruption to flows through the Strait of Hormuz would tighten global supply immediately. The geopolitical risk premium in crude has widened, with Brent approaching $70 resistance. Higher energy costs flow into inflation expectations, complicating the rate cut outlook for the Fed and ECB. Key numbers to remember. Brent settled at $70.18, plus 2.0%, highest since late January. WTI at $64.93, plus 1.5%. Iran exports approximately 1.6 million barrels per day of crude and condensate, OPEC's fourth largest producer. U.S. Maritime Administration advisory issued for Strait of Hormuz transits. What to watch next? U.S.-Iran diplomacy remains the key swing factor. Oman-mediated talks showed initial progress, but the carrier deployment threat and tanker seizure contingency keep the tail risk elevated. A diplomatic breakthrough would likely deflate the premium quickly, pulling Brent back towards $65. Failure or escalation could push crude above $72 and reignite inflation hedging across rates and FX. 3. Takaichi landslide lifts Nikkei to record on fiscal expansion mandate. Primary asset classes impacted: Japanese equities, Nikkei 225, topics, tech, financials, JGBs, 10Y, superlong, USD/JPY, yen crosses. What happened? Japan's PM Takaichi won a landslide in the snap election, with the LDP-led coalition securing a two-thirds supermajority. Markets surged on expectations of expanded fiscal stimulus, including a 2-year food sales tax suspension. SoftBank rose 10.7%, leading a broad tech and financials rally. Why it matters. A supermajority gives Takaichi the legislative power to fast-track fiscal expansion, which is equity positive, but raises debt sustainability concerns for JGBs. The pledge to suspend the food sales tax and increase defense spending adds to an already stretched fiscal position. The yen weakened on expectations of larger bond issuance and a wider policy divergence with a tightening BOJ. Key numbers to remember. LDP coalition won 316 of 465 seats, clearing the two-thirds supermajority threshold. Nikkei 225 closed at 57,651, plus 2.28%, a new all-time high. SoftBank surged 10.7%, Furukawa Electric plus 22.9% on earnings. What to watch next? Japanese markets are closed Wednesday for a holiday, so the next session is Thursday. SoftBank earnings on Thursday will test whether the AI investment thesis can sustain the rally. BOJ commentary on the fiscal-monetary interaction will be critical as markets assess whether the central bank can continue tightening amid aggressive fiscal expansion. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.